Thank you everybody for joining this uh, small presentation on a Friday afternoon. Thank you so much for taking out the time. The agenda behind today's presentation, which is given by me, Karan Mehra, is to explain to a lot of our users about what exactly this product is that we have released called Amplio Red. Why do we feel this product was required to be released in our portfolio of other products? And how can this product be used uh, by you as an investor in your fixed income and investment journey? What I will do is I will spend 10 to 15 minutes in explaining this particular product through a presentation that we have created for you. After which we'll open it up for questions and we'll try to address as many concerns about the product as we can. Okay, perfect. So a quick introduction about us for the ones who don't know what we do. Uh, the company Amplio is a wealth management organization based out of India, focusing on fixed income products which provide a high yield, low risk return to investors uh, of all sorts of categories from retail, HNI, institutional, corporate, etc. Today's product is something we call Amplio Red. Red stands for receivables discounting. Typically, what we're seeing in India is a very interesting mix of capital allocation across various fixed income products. However, as per recent studies done uh, globally and especially in India, less than 3% of HNI and HNI corporate portfolio is allocated to alternatives. I do not include about investments off the capital markets and apart from real estate portfolio. This number is almost 10x globally, especially in countries like US, certain parts of West Europe, and uh, certain parts of Australia as well. Indian HNIs are averse, not aware, or slightly the education level of what alternatives stand for is something which hasn't reached uh, our Indian HNI and corporate exposure. Typically, for someone who wants to understand what alternatives means, it's something we define as any investment product available today, apart from your capital markets allocation and your real estate allocation. That's something we define as alternatives. It could include unlisted shares, it could include startup investment, it could include unlisted bonds, it could also include FDs that you have. So again, the problem we're trying to solve is that we feel the allocation of HNIs, family offices, and corporates could 10x from where we are today. We feel we can introduce some very interesting products which, in the entire jigsaw puzzle of risk and return, uh, sit at a position where, for a considerably lower amount of risk, uh, an alpha return can be generated, which is double digit in fixed income, something which most investors are attracted by. At the same, apart from being low risk and high yield, there are also investments which are liquid and can be exited in really short term intervals, which usually is the biggest problem in non capital market transactions. We'll explain to you how we solve for that problem later, but that's typically the three uh, aspects we look at, which is risk, return, and liquidity. So the promise or the problem we're trying to solve is how do we create a low risk, high yield, and high liquid product which could uh, pick up a significant portion of the allocation of your portfolio into alternatives. Again, the most commonly used uh, supply chain financing, invoice financing product in India is usually done by banks and large NBFCs, which is using the TREDS platform that RBI has introduced, where a lot of anchor-led financing or invoice financing models are discounted. Uh, Roughly 48,000 crores of invoices were discounted on this particular platform in FY25 alone, which is a staggering number. Allocation of these platforms or allocation of, I would say, mid-market and large corporates understanding the need of using supply chain financing specifically from such platforms over the last 5 to 7 years has increased drastically. The reason that has happened is because of various integrations that companies like us can do is with GST, e-invoicing, MCA data, CIBIL data, data across bank account statements, etc. Even after such amazing underwriting abilities are available to us, uh, the penetration is very less. It's less than 5%. Even today, a lot of large corporates and institutions who come and borrow capital do not understand how supply chain financing as a tool can really multiply your business uh, uh, and help you manage working capital and cash flows in a much better way. So that's a journey we're on. That's a journey which I think a lot of other financial services companies like us are trying to solve as a very big problem, which is super underpenetrated in India. Now let's talk about our latest product, what this product is, how does it work. So the product is known as Amplio Red, RED Red. Red stands for receivables discounting. This is our first product that we have introduced in the supply chain financing space, which is regulated by RBI. Now, what does this mean? RBI has this very interesting regulation, which we will also share with you after this presentation, called securitization of standard assets. What securitization of standard assets typically means is that RBI allows regulated entities like banks and NBFCs to be able to securitize and sell a portion of their receivables or a portion of their assets or the loans that they have given to that they have given ahead to companies in a very structured manner, which accredited investors, HNIs, and corporates can invest in as an investment product, very similar to bonds or very similar to debentures. So what that typically means is there are 2 or 3 additional, I would say, players who come in this particular product apart from invoice discounting. Typically, in a regular invoice discounting, which you guys have been doing with us, and otherwise, there are only 3 players. The 3 players are you as an investor, the company whose invoices you wish to discount, and a facilitator or a platform like us, like Amplio. What typically happens in a regular invoice discounting is certain amount of bills are uploaded for discounting by the company or the seller. These invoices are approved by the platform and then forwarded for discounting to investors like you. You pick and choose what invoices you wish to discount, what companies you wish to work with, and you discount the same by financing a portion of that particular transaction. On repayment, again, the same flow happens. The repayment is received by the buyer in the escrow account, which then is eligible for you to either reinvest or withdraw that capital in case you wish to use it for consumption. Now, the additional 2 or 3 elements which come in regulated invoice discounting or something we call Amplio Red are mainly 2 important parties which come in play. One is an RBI regulated NBFC. Now, a very important aspect of why this particular product uh, is something which we are confidently and we are very uh, bullish on is the aspect or the entrance of a regulated entity which is in the business of giving loans and advances or in the business of financing, which is an NBFC. We have partnered with a group company of ours called Ganga Based Barter Private Limited, which is a non-deposit taking NBFC allowed by this RBI regulation of securitization of standard assets to give loans or to discount invoices of its own of the clients that it chooses and then downsell the same ahead. Now, uh, what is very important to understand is that if you are a regulated entity in the business of financing, there are certain powers or certain benefits you enjoy. Certain benefits that we enjoy is we now have the ability to report every single invoice discounting transaction that we do in the credit bureau of our country, which means any delay, any default, any issues created by the borrower will have a direct impact on his credit score. In an industry today, another very important benefit of reporting a transaction in the credit bureau is that other lenders of that particular borrower are also made aware of the fact that this particular borrower is discounting these invoices with us as an NBFC. This creates a very transparent ecosystem for the borrower and for lenders to understand the past history and the past performance of the borrower across all his loans and allows you to make more justified and more data-backed decisions about your business possibilities with that particular borrower. Now, the second, now the now once now one very important aspect of what happens in this particular structure as opposed to invoice discounting is that the NBFC has to give or has to discount the invoices of the particular seller first with its own capital or with the capital that it has accumulated in its books of accounts first, as opposed to invoice discounting where the capital is being collected and then sent to the partner. Over here, the capital has to be first advanced by the NBFC to the borrower. Once that has been done, there are a few regulations we have to follow, a few rules we have to follow, which I would like to put light on. The first and the most important rule which we have to follow is the rule of MHP or minimum holding period. What that typically means is that as an NBFC, I am not allowed to downsell or to basically securitize these particular receivables and sell it to you as an investor until and unless these receivables have stayed on my books for a minimum of 2 invoice cycles. What that typically means is, in case company A has raised invoices on company B and us as an NBFC are discounting the invoices of company A, we will require 2 times when these discounting activities have happened and we have received the payment from the buyer for it to be eligible to be securitized and downsold to investors interested in investing in these particular products. What this rule typically does is that it makes sure that we are unable or we are not allowed to sell down only the bad book or the book that we feel is not performing. Another interesting addition to this particular rule is that in case in those 2 cycles, if the invoices are running delayed or the payments are running late, in that case, again, I cannot securitize and downsell these invoices to you. Second, and the most important rule that I think people need to understand is that in this particular process, we have to maintain something called an MRR, or a minimum retention ratio or minimum retention rate. What that typically means is that minimum 5% of every single invoice that is being downsold or securitized has to be the exposure of the NBFC in that particular invoice. So simply speaking, if the invoice value is 100 rupees, the maximum amount that we can downsell is only 95. These two rules are very important characteristics of RBI's securitization of standard assets and of Amplio Red receivables discounting, which serve as a heart or a base of understanding the quality of this particular product and how we are trying to address and downsize the risk while maintaining a consistent return. Another very interesting opportunity which has come up with this particular product is the introduction of demat accounts into our entire ecosystem. Any Amplio Red PTC or pass-through certificate or investment that you make with us will be directly credited to your demat account, which gives you a transparent understanding or a transparent holding of exactly what you hold and creates a very strong and trustworthy ecosystem for us. Another very interesting aspect of this particular product was something which a lot of our HNI and institutional clientele used to discuss with us, was how can we make these investments tax friendly or tax benefit. I'm very happy to announce that the way we have structured these investments have been structured in a very tax advantageous format, which allows you to enjoy capital gains if held for a long-term purpose, making them taxable at only 12.5% in that particular case, which really boosts your post IRR yield and allows you to significantly benefit from these LTCG regulations made available by our government. Okay, now before I move here, I want to tell you about how the structure works. This might get a little complicated, guys, so I would just request you to concentrate for a minute. The way the structure works is very simple. The NBFC, which is Ganga-based barter, discounts invoices of, let's say, seller A. The NBFC, then after it meets its MHP and MRR rules, which I explained earlier, has the ability of securitizing these invoices and assigning them to an independent third-party trust. Now, these trusts are mandatorily required to be opened, operated, and managed by SEBI-regulated debenture trustees. Currently, we have two partners named Midcon Credentia and Beacon Trusteeship, which facilitate this particular process for us. Once these invoices are assigned to this particular trust, various agreements are entered into, which is very similar to how a prospectus of an IPO happens. The agreements we enter into are as follows: an information memorandum, a trust deed, an assignment agreement, a power of attorney, a collection agreement, a servicing agreement, and a power of attorney. These are the 7 to 8 documents that I entered. Every time invoices are securitized and assigned to the trust. Once these invoices are assigned to the trust now is eligible to issue PTCs or pass through certificates, which are also commonly known as SDIs in this market, or securitized debt instruments, to various investors. These particular instruments or pass-through certificates are issued through the IM, or the information memorandum, as a part of the list of documents which I mentioned earlier. Once these uh, once the subscription value or the investment value is received by the trust automatically gets these invoices assigned to itself and transfers the consideration or the purchase consideration of these invoices to the NBFC. Please note, it is RBI regulations rule that the invoices can be assigned to a trust in this particular structure only at face value. It cannot be assigned at a premium, which means that uh, it is difficult for us or for any other player to inflate the value of these invoices or these PTCs. They have to be issued at face value. Once, once this process is completed, the whole allocation process of your particular PTCs in DMAT or otherwise starts, and that process usually takes 7 to 10 days with NSDL or CDSL. Now, I would like to explain to you some eligibility factors and the mechanics that we use while we are curating these invoice pools. Number one, as all of you all know, these are GST verified anchors, credit worthy sellers, usually large listed companies like Tata, Reliance, Amazon, Flipkart, Adani, etc. The tenure of every single invoice that we are discounting is usually between 30 to 120 days. The reason we do that is because we want to make sure that we have a highly liquid and very fast churning book, which constantly gets replenished on a 60 to 65-day average interval. We also have rules like we avoid overexposure in a particular sector. We do not take risks only on a single buyer for a single client. And we also make sure that we avoid anchors or we avoid certain sectors which currently are seeing a downtime or basically are under a threat in this particular economy. Also, another very interesting aspect is that all distributions made over here with respect to with respect to investor interest, with respect to any fees, with respect to any collections or repayments received from the buyer, are completely and independently managed by the trust. Our role as Amplio has become limited. Some interesting credit enhancements that we have built up in this particular product is something I would like to share with you. Like I mentioned earlier, there is a 5% MRR, or minimum retention rate, uh, that we have in this particular product as per regulation. But we have topped that. Apart from just having a 5% MRR, we've added an additional safety feature for you, is that we have made this 5% MRR an equity tranche. What I mean by that is this particular tranche bears no interest. So there is no cost or there is no interest income for us on our 5%. Number two, this particular tranche is junior or subordinate to the investments made by you in the PTC, which typically means that only after your principal and your interest has been repaid is when we receive our 5% back at the end of this particular PTC. Second and most important thing is that every single invoice that we discount, we're only discounting roughly 80% of the value of the invoice. What that typically means is that our collections or our receivables for that particular invoice are 125% of the loan value. This allows us to again uh, create a certain buffer or cushion in case payments are short or running late. Third and the most important thing is, like all of you all know, these are certain powers that we enjoy now as working with an NBFC in the group, is that we enjoy debt recovery tribunal power, which is DRT. We also enjoy civil reporting powers. We also collect post-dated checks of 1.5 times the value of the loan. At the same time, in some cases where it is eligible for us, we also take a personal guarantee from the main promoters who are running that particular business as a borrower, which also allows us to maintain skin in the game. Like I already mentioned to you, we have two SEBI trustees which are independently managing this structure. The trusts have separate collection and procurement accounts, CNP accounts. We don't have access to it as well. We have to ask them to wire funds after they have verified all information from their independent accounts. Usually, most of the trusts that we work with house their accounts in ICICI or Axis Bank. A very, very interesting and a very proud feature for us is that we have built in our insurance program, which is Amplio Red, in this particular structure, which means that every single invoice that you buy through a PTC is 100% insured by Universal Sompo's CLIP policy that we have received, which we call Amplio Red. This means that the risk has been significantly reduced using these various and interesting credit enhancements that we're able to provide in this particular structure. This architecture is going to allow us to build a robust ecosystem which helps you as an investor to make decisions and on a high yield by looking at and maintaining your risk. Another simple insurance point I'd like to cover. Like we boast of a 0% default rate till now, 100% repayments on time. Our AUM in just supply chain financing on the sales invoice discounting side has crossed 1,000 crores now, which we are very happy to boast about, while providing a handsome return, which comes to a pre-tax IRR of between 12.5 to 13%, is something which would be a statistics until now. Like I said, 30 to 120 day liquidity cycles. We also are giving DMAT. We're also allowing you to exit these particular products as and when these repayments are received by us. So you'll be seeing a lot of deals from your relationship managers, which range from 30, 60, 90, 120, etc. The reason that is done that way is because we're trying to match the repayment of the invoice to your exit date, hence removing any risk of asset liability mismatch. We feel private credit is an opportunity which has been evolving in the last 4 to 5 years. It has now reached a position where Asian private credit perhaps has become the most famous product for large pension funds, large endowment funds, and large insurance funds all across the world. Capital allocation in Asia and especially in India has only been increasing post-COVID in private credit products. We feel this particular product stands all the way there. We feel this product has the maturity, has the structure, has the credit enhancements which allow you as an investor to safely invest in these particular products without having to worry. I would proudly say that our products are investment grade or more, and the risk that we are underwriting and the structures that we are creating using our entire ecosystem of NBFCs, supply chain financing companies, RIAs, etc., allow us to give you this product, which, apart from giving you a high yield, also downsizes your risk through various methods. I would like to remind you or refresh your memory of what your journey would be in case you choose to invest in these particular products. You would transfer funds into your pocket on Amplio. You would choose what PTCs you wish to invest, and Amplio would transfer those PTCs to you as an investor. They would reflect in your demat account within 3 to 4 working days. And on the liquidity event, which is 60, 90, 75, 120, whatever you choose, or whatever that particular investment opportunity allows you to choose, you can immediately sell your PTCs from your demat account. You can transfer them from your demat account using the online demat account transfer facility or the offline facility directly to us as Amplio, and we will immediately transfer the money into your pocket on the same day or the next day morning once we receive those demat account transfers. The process is pretty simple. We've tried to follow standard processes that we could meet in the market to make your learning curve less and allow you to enjoy these products. Thank you, everybody. I'm going to stop sharing now and we can take up more questions. What is the concept of accrued interest? Why is this being charged to an investor? As in, when I choose one unit to invest, instead of 1 lakh, it shows a much higher amount to be invested. Can you please explain this? Surely, I will explain this. So, one thing which everybody needs to understand is that the underlying product or the PTCs, as opposed to invoice discounting, are already active loans given by the NBFC. So the NBFC is selling its asset to you, which has already been created, which means that those loans are already earning interest. Now, when we calculate purchase consideration of the amount that the trust has to transfer to the NBFC in order to buy that particular asset, we have to consider the loan value and the interest that has already been earned but not paid to the NBFC for the number of days that it holds that particular asset. And that is what accrued interest is. But nothing to worry about. When this repayment is received by you, you will receive the repayment for the entire tenure. Hence, your accrued interest gets adjusted. So, in very simple language, this is also how bonds, listed bonds, and various other products also work. Let's say today the NBFC gives a loan for 90 days or discounts the invoice for 90 days and downsells this particular invoice to you as an investor on the 60th day. Now, you will transfer the funds to the NBFC for the loan value plus the interest for 30 days. And that is what is accrued interest. Now, when you receive the payment or you receive the repayment from the company, you will receive the repayment of the loan value plus 90 days of interest. So you have received interest for 60 days, but you have paid 30 upfront. Hence, that is the concept of accrued interest. As the PTCs are for max 120 days, how will the continuation of the investment happen for long-term capital gains eligible for 2 years tax at 12.5%? A very interesting question, sir. The way we've structured these particular PTCs is a structure which we call replenishment only structure. What that typically means is that the trust has an option that at every repayment that it receives from the buyer in the trust account, the trust can do two things. The first option is the trust can either repay that value back to the investors and end the trust and hence end the transaction. The second option is the trust can choose to replenish the amount received in new invoices from the same buyer and seller. Replenishment allows the trust to again reinvest the money back in the same deal. Hence, the way we have structured our PTCs is that for 2.5 years, unless you as an investor choose to withdraw the money or decide not to continue, the trust can replenish or reinvest this investment back into the same bills or the same combination of bills of buyer and seller for 2.5 years until which the trust will stay active. After 2.5 years, the trust has to naturally dissolve and repay the investors. That's what I mean when I say replenishment and a long-term capital gain structure. What are the risks associated in spite of an insurance in place rather than withdrawing? Okay, so the risks associated in spite of insurance are certain risks which are also mentioned on the insurance document, like fraud, uh, act of God, war, political events, etc. The interesting thing is the way we're able to hedge these risks in the process. The first and the most important thing that we do when we're hedging these risks is we always take a buyer confirmation every time an invoice is raised. That typically allows us to confirm that the invoices are genuine, dispute free, and are going to be honored by the buyer as he has confirmed on them. Second, and the most important way we are able to disassociate the risk is by making sure that the buyer directly pays it into our escrow system as opposed to paying the seller. These two ways allow us to hedge our risks substantially. Apart from these, the clauses which they are mentioned are very standard clauses which are mentioned in any insurance, like act of God, war, etc. Rather than withdrawing after 2 years, is it possible for me to continue as long as needed, like 3 or 4 years to get LTCG, or I need to create new cycles every 2 years? Our current structure allows for 2.5 years at best, is the maximum amount for which you can stay put. But I would request you, sir, to get in touch with your RM. We have instances in the past where on a specialized structure for a certain minimum amount of investments, we have created structures for longer period as well for our investors. But for 2.5 years, you will still enjoy LTCG benefits. My question is on the type of investment options. We can see one is received demat and another one. How are they different and what are the tax implications? So we do have an option which allows you to invest in a non-demat form as well, which means physical or digital certificates in that particular instrument, which is what we call non-demat. The tax structure for both remain the same. There is no difference in tax. We do pay stamp duty on both demat and non-demat. So the difference is only in the method of delivery of that particular investment to you. And there's no other difference apart from that. Why is interest amount not showing in insurance certificate? Please try to understand the nature of the insurance that we have. The nature of the insurance is something we call a CLIP, or a contractual liability insurance policy. Typically, what we're ensuring is we're ensuring the risk of the buyer not paying or defaulting or delaying on the particular invoice that has rightly been raised on him. Hence, you will notice that the insurance is usually for the invoice value, which is usually 125% times 125% of the investment you have made. So that's the reason interest amount is not shown in the insurance, because what is being safeguarded is the entire invoice value and not just your investment and interest. In most cases, in 99.99% cases, the invoice value will always be higher than the interest and the principal that is due to you. Is demat account mandatory? No, demat account is not mandatory. We do have non-demat options. However, we promote demat because it allows you as an investor to have a more transparent view of your investments in your CAMS in your CAM statement, and it also allows for better reporting for you as an investor. Yes, we are. There's a question regarding, are we adding more companies in the future for PTC? Yes, we are adding more companies for PTC. On an average, we are working with the NBFC to onboard minimum 2 to 3 clients weekly right now. So we're expecting more companies to come in the future as well. As the AUM grows, as more investments happen, we constantly keep diversifying our exposure across all products to one company is never more than 2 to 3% of the entire AUM that we have built. So the idea is to diversify across multiple companies. I see approximate 1.1% reduction with Amplio Red compared to the past ID of same tenure. Any reasons for that? So one very important aspect regarding rate is that insurance is inbuilt in Amplio Red. We're not charging separately for insurance. And the cost of insurance earlier was around 2.5% per annum across deals. So technically, the ROI that we're providing to the investors is actually higher in this particular structure as compared to the earlier structure. And the reason we're doing that is because we were able to negotiate bulk rates with our insurance partners for this product, which has been passed down to you. And B, we feel that that really increases the quality of the structure and makes it investment grade and makes it an investment product which can be further listed and even rated and can be put in the capital markets. Hence, it's a long bet which allows us to make it a product which can be accessible at a larger scale as well. I don't get the benefit of diversification. While I see bunching of 3 sellers, is it possible for us to bunch 20 sellers to reduce risk, or do we buy units of 20 sellers ourselves, splitting our money? As per the current structure, it actually makes the product and the risk much lower for us when we don't bunch too many together. The reason is that it creates better control in collections, better control in receivables, better structuring with the trust. So my suggestion would be, for now, you can yourself split your money and buy different sellers. However, we are seeing demand from investors who are asking us to build a concentrated portfolio PTC as well. So we're working on that, and we will be launching those very soon as well. So for now, you can split your money across various sellers, and in the future, we can build a PTC for you which has various sellers in it as well. There is someone who is mentioning there's a delay in unit transfer to DMAT for a few investments. Yes, that's true. A couple of our series are running late on DMAT transfers. That is because there was an issue at the creation of an ISIN at the NSDL and CDSL level. We completely apologize for that, but it's beyond our control. The last update we have gotten is that the ISIN has been created and the transfers have been initiated, which should be completed within a week's time. So apologies for that delay, but DMAT structure is something which I feel everyone should do, and something which may have its initial challenges in terms of structure and the process, but I think overall, over a period of time, it's something which creates better reporting. There's a feedback like fixed income, like fixed deposits have option to renew principal only on majority. Can we have similar option in PTC as well? Yes, that can be built in. That we have an opportunity to increase the life of the trust and replenish at the end as well, in case every investor who's participated agrees to the same. So we will throw in that option at that particular time, and in case we hit majority or approval, we can go ahead with that. There are two categories of deals on showing on our platform. One set with regular 30, 40, 60, 90 days, and the other set for 500, 800 plus days. What's the difference? So, like I mentioned, we are also launching products with the PTC which are slightly longer in tenure. This allows investors who are looking to invest on a long-term basis and are not looking for liquidity in the middle to stay invested and stay put. There are various benefits of compounding we are offering in that. So we have investors who are wishing to stay invested with us without touching their portfolio for 2, 3, 4 years as well, and that's when those deals get triggered. So yes, you will see options of really long-term deals as well, which have DMAT, don't have DMAT. Like I said, DMAT is a method of delivery. It is not something which uh, is required for short or long deals. It's just a method of delivery. So yes, you will see us introducing really long-term tenure above 365-day deals as well with the introduction of PTC. Okay, uh, lovely. Thank you. Thank you so much, everybody, for joining this call. We're all available after this call as well. All of you have relationship managers, connects with people in our company. Any questions you have post this call or post this particular interaction of ours, which you need more understanding about or want to uh, understand better, or something I haven't been able to clarify, or some questions I've not been able to answer, please reach out to your RMs and we'll be happy to get those answers in place. The idea behind this product was to give you a high yield, low risk product which was RBI regulated, coming in your DMAT, and hence allowing us to give you a very, very high investment grade product, which allows you to really diversify your risk and enter the space of alternatives if you haven't, uh, in a very safe and secure manner. Uh, any feedback on the product, how we can make it better, uh, how risks can be managed, we'll be happy to interact with any of you, and looking forward to your feedback. We'll constantly keep iterating this particular product as well as we keep learning and as we keep uh, seeing your feedback. And thank you so much, everybody. Thank you. Have a good weekend.